Thank you very much. So once again, good evening and welcome to the 48th meeting. Remember, it's 48, so 4 more meetings, you'll get rid of me.
You know, that's you who's counting, not us.
Aarti, welcome. Wonderful to have you with us. We have Aarti Desikan from Executive Director of Anniversaries, and I think a person who's known to just about everybody on this group, daughter-in-law of SLV Narayan, popularly known as Babu. Welcome, Aarti. Lovely to have you with us.
Thank you so much.
I think we can't hear you, but I think the mic's okay. We also have with us Vijay Singh from Anniversaries. And Vijay has been also pretty popular with our Raila group. I think you addressed the group at Raila, I think, right? And it was nice of you that you gave them a very, very encouraging talk, and people are very excited to hear you. I got some excellent feedback from there, and you also offered them some internship and things like that. So lovely. Thank you. Lovely to have you with us, Vijay. And thank you.
Thank you so much, sir. Thank you.
Aarti, also, thank you for supporting us during Golfity. I think we have Anniversaries came out and supported Golfity, and a great cause that you helped with. We look forward to your continued support with the Rotary.
An absolute pleasure for us as well.
Thank you. Like I said, we have another 4 weeks to go. The next 2 meetings, out of the 4 meetings, 2 of them will be in-person meetings and 2 of them will be virtual meetings. One will be a project meeting. I think we'll send you the details shortly. But the last week was exciting from the perspective of having had a fantastic overnight picnic with about 17 families. Great time. We missed the people who couldn't make it. And the last few meetings of the committees are happening. The last board meeting is happening. It's a joint board meeting that's happening tomorrow. And all the avenues of service are winding up. We had a great year, fantastic year. And I hope the people here, I want to just personally inform you that on the 30th, we'll be getting together for our fellowship and the finale of this year. So please mark your calendars, and I look forward to having you all celebrate this year together. Without any further ado, I'd like to hand over to...
Can I just interrupt for a minute? I have a guest, Mr. Srikanth. I don't know whether he's there. I think I saw him. So Srikanth, KP Srikanth is there.
Srikanth, are you there?
Yes, sir.
Hey, Srikanth, quick introduction.
Okay, I'm Srikanth here. I work with a company called Mercer, setting up the private wealth practice in India for them. So that's about me on the professional front. On the personal side, I am an avid bike rider, so do a lot of endurance riding. I have a biking club called Royal Escapades, which also supports local government schools. So we do a lot of work for them. We provide stationery and uplift those schools. Like providing with the chairs, library, books, and all those things.
Lovely to have you with us, Srikanth. We have a lot of bikers here in our Rotary group also.
Great.
Just to mention that Srikanth is also a prospective member.
Lovely, wonderful. Looking forward to seeing you.
Thank you, sure, sir.
And Aarti and Vijay, the invitation is on to you also. We'll be happy to have you on board as Rotarian sometime.
Yes.
May I hand over to Club Secretary Nanda for the announcements?
Well, good evening, everybody. The last week actually was a fully packed one with a lot of events. In fact, I would say even the last month was a jam-packed event. In fact, I just finished the reporting of the last month. We did 17 projects in the last 1 month. Coming back to the last week, the annual overnight picnic was organized by the Club Services Committee at Chikmagalur on the 20th and 29th of May. And that is a great success with 17 families participating and spending quality time together over a period of 2 days. The Youth Services Committee organized an education tour for 50 children of a government school in Malur in Kolar district on the 28th of May. The program that was organized with the NGO Mairada and the management of the school enabled the children to gain an insight into the conservation of the environment. They visited the NGO's forestation and biodiversity conservation areas. The Community Services Committee conducted a blood camp on Sunday, the 29th of May at 10 a.m. in association with Sir C. Raman General Hospital in Bangalore at this Little Angel School premises. The community services again also completed the rejuvenation of a water body in the Chintamani Taluk. While the farmers around the area have already benefited by gaining access to the soil during the desiltation process for their farming requirement, the area that will hold 10,000 cubic liters of water will recharge the groundwater table and will also benefit about 300 families in that area. Now, coming to the committee meetings, the International Services Committee held the last meeting of the year on the 27th of May. Similarly, the Vocational Services Committee also held a meeting on the 30th of May. The trustees of the Bangalore Cantonment Rotary Trust held their third meeting of the year on the 30th of May. Now, for the birthdays and anniversaries that are being celebrated this coming week, after a gap of 2 weeks, there are quite a few Rotarians who are celebrating their birthday this week. Rotarian Vinay Pai celebrates his birthday today. Rotarian Ashok is celebrating his birthday on Saturday, the 4th of June. So also Rotarian Ganesh celebrates his birthday the same day on Saturday, the 4th of June. Then a Rotarian who has got unlimited energy and phenomenal passion to do projects, Sadashiv Shetty, celebrates his birthday on the 7th of June. Moving on to aunts, we have Sahina Nasser and Hamsini Appadurai celebrating their birthday today. As for wedding anniversaries, we have two couples who are in the limelight. Our honorary member, Dr. Hemant Kalyan and Anne Biraj Kalyan celebrate their wedding anniversary on the 7th of June. So also Rotarian Shivdev and Anne Rekha are celebrating their wedding anniversary on the 8th of June. On behalf of all the members, I wish all the Rotarians and aunts who are celebrating their birthday and the wedding anniversary the very best on their special day and in the years to come. Now moving on to the programs for the forthcoming week, on Monday the 6th of June, our club is participating along with Rotary Bangalore and Rotary Indiranagar in the annual Antakshari competition that is being conducted by Rotary Bangalore at the House of Friendship. Request all our members to be present to cheer our team that comprises of Rotarian Madhuchanda and Anita Agarwal and the Rotractor of SSMRV Alima. The Community Services Committee is in association with the Rotaract Club of SSMRV is conducting a blood camp at their college premises on Monday, the 6th of June. The Community Services again is all set to complete this coming week the Happy School project at the government school in Malur in Kolar district by completing the construction of a separate toilet for boys and girls, establishing wash stations, and donating computers to the school library, sports equipments, and school bags to the children of the school. The joint meeting of the current and incoming board of directors will be held tomorrow at the Bangalore Golf Club. The meeting, fellowship, and dinner is being hosted by Rotarians Bharat Bel, S. Venkatesh, Venkatraman, and Rohit Karant and their aunts. The next regular meeting that is being held on the 9th of June will be the last club assembly and business meeting of the year. The agenda for the meeting and the related documents have already been circulated. This is an important meeting and so request all our members to attend that meeting. That's the announcements for the week. Thank you.
Thank you, Nanda. A whole lot of projects that we did over the last few weeks. I sincerely request each one of you to participate in the next few meetings, the General Assembly and the General Body meeting, the Charter Night, and there's one more project meeting that's happening. So those three meetings extremely crucial, apart from the Fellowship Night that will be happening on 30th. Please make yourself available for the next few weeks to be on all the Thursdays to join the meeting. And also a request to all of you to join us on Monday for the Antakshari. Rotary Bangalore is hosting it. They have personally invited each one of us to be there. There's going to be a lot of fun and fellowship that's happening. It will be nice if many of you can join us. Without any further ado, I'd like to call upon Rotarian Venkat to introduce our guest speaker for today.
Thank you, President Vinod. This is an absolute privilege for me to be introducing Aarti Deshikan, who first of all is not new to the club. Everybody knows Aarti more than I do. But I get the privilege of talking about Aarti. So while thanking Aarti for accepting our invitation to speak and address us, a brief intro about her, the side that you probably don't know much about. Aarti Deshikan is the Executive Director and Unit Head of Bangalore for Anand Rathi Wealth. She joined Anand Rathi in 2011. So she has spent about 11 years with the group. She's been part of the core team, contributing to the region's growth. In 2019, she took charge of the Bangalore team as a unit head. The enormity of what Bangalore team does in terms of numbers is that she has seen the team increasing their assets under advisory and assets under management. The Bangalore team manages about 13,000 crores worth of assets under advisory, out of which 7,800 crores are the assets under management. So there's about 5,000 crores of pure advisory and 7,800 crores of assets under management. So that is the kind of trust that Bangaloreans have put on Aarti and her team. So currently, Aarti works along with 52 team members in building the Anand Rathi Wealth brand in Bangalore, essentially in the HNI segment. Aarti drives the team towards delivering its business goals, provides both strategic and technical inputs to the team, and focuses on business development. So along with leading the team, Aarti also does a lot of work hands-on. She personally manages over 480 crores worth of assets for 60 clients, of which she is the sole advisor for 52 families. So that's the kind of personal equity that she has with some of the customers from Bangalore and worldwide. So her domestic base includes clients from Bangalore, Chennai, and internationally she has clients from the US, Kenya, and Singapore. She has over 20 years in the industry. So I would say 20 years in this fast-paced, highly turbulent industry, I think has really hardened her. And we know what to expect from her during her talk. Aarti believes that knowledge and integrity are crucial to building trust in any relationship. And she also believes that the inputs given must be simple, transparent, and lucid. Today, she's going to talk to us about deconstructing the meaning of money management. Well, we all understand it at some level. There are multiple layers to it, and we look forward to Aarti deconstructing money management in itself. So Aarti, just a quick, we have a lot of people on the call today, and I'm sure they've all heard buzzwords like inflation, stagflation, crypto, and rate increase, rate hikes, and stuff like that. So please don't be surprised if you get questions around those areas. And without further ado, I'd like to hand it over to you. Thank you again.
Thank you so much. That was truly a wonderful introduction. And thank you to everyone at Rotary Cantonment for giving me this opportunity to talk today. I have met with many of you over the years, but never really to speak about wealth management. So thank you to everybody who's here today. I think given that we have around 45 minutes, what I would like to say is that whatever I'm presenting will be really simple or uncomplicated, as the Anand Rathi logo says, logical and hopefully relevant to all of you. And one of the reasons we do these webinars at Anand Rathi is that we believe that wealth needs to be managed, taken care of, nurtured and grown with a joint responsibility between you, your family, and your advisor, with the right principles in place. And today, what I'm really going to do is to take you through some of those thoughts and principles that we believe in and we follow. And hopefully, as the owner of your wealth, there will be certain key takeaways that you get from today's presentation. So let me jump right into what I have today. And the way I would structure this is that I would speak for maybe 25 to 30 minutes, and then open it up for any kind of questions that you'll have. And so hopefully this will be an interesting session. So let me just start. Can you see my screen?
Yeah.
Great. So I think we mentioned that the topic was to really deconstruct the meaning of money management, and that's what I've really put down here, which is how do you decode what wealth management means? So let me start with telling you a little bit about Anand Rathi. We as a company manage assets of over 32,400 crores across 7,000 high net worth individual families. We have around 650 employees at Anand Rathi Wealth. And our portfolios are audited by one of the big four, which is actually Deloitte. And yes, we have been recognized as a great place to work for 5 years in a row, 2017 to 2021. Of course, the most important part that I would add to this, which is our pride, is that we are also now the first listed wealth management company. We listed 6 months ago. And that has been a great achievement, especially for some of us who've been with the company for the last 11 years. So let me start with telling you a little bit about what we do at Anand Rathi. We believe that we have to define everything that we do. So if we say we are wealth managers and we do wealth management, we really like to define what our understanding of wealth and management is. So let me start with the first term. What is wealth? I would, if this was a forum where I was meeting you all, I would have probably asked you all, what your definitions are. But again, given the paucity of time, let me just quickly tell you what our definition is. If anybody believes differently, I'd be happy to know. So our definition of wealth is very simple. It is the sum total of all your assets, right? Now, what do I really mean by that? Your assets would typically fall under certain asset classes. It could be equity, it could be debt, it could be real estate, it could be commodities. But what we think is really important is that you should know what your entire balance sheet is. You may have investments in insurance, in a fixed deposit, like I said, real estate, provident funds. But invariably, what we have seen in our experience is that people don't know what that overall balance sheet looks like. You would know, at the tip of your fingers, your balance sheet for your companies or your businesses or your profit and sales figures. But I'm not sure how many of you all would have that number as to, this is my overall balance sheet, this is my asset allocation. And therefore, we believe that the definition of wealth is the sum total of all your assets. However, when it comes to wealth that needs to be managed, we just add this one extra line, which is the sum total of your assets minus your aspirational assets. Now, what are aspirational assets? The house that you live in, or the car that you own, or maybe a holiday home, are what we call aspirational assets, because you have bought that without the objective of making money off it necessarily. So when it comes to managing your wealth, your overall balance sheet minus your aspirational assets is the wealth that we look at managing, right? So my first takeaway is, please know your entire balance sheet.
We are not able to screen. In case you're moving the screen, we are stuck on the decoding wealth management screen. We can see that now. Yes.
Okay. Are you able to see this?
Yeah.
Okay. Sorry. I assumed you all were able to see the screen. So I think when I get into the slideshow mode, it doesn't move down. So I will keep it in the right. So yes. So this is what a balance sheet looks like. You have certain assets that you would have across all of these headings. It could be equity, it could be real estate, it could be structured products, it could be debt.
Sorry to butt in. I think without going into slideshow mode, we're not able to read those the fonts. It's pretty small. Is it okay? Try and go into slideshow mode.
Is this better? I'm making it a little bigger.
Bigger, yeah. That's a little better, of course. Yeah.
Yeah. Great. So I'm going to move forward, which is the next part, right? So I've told you what wealth is. So let me explain the second word, which is what is management. Again, here we believe that management is no different from how you all manage your businesses or projects that you'll do. And that is 4 simple steps. You start with defining your objective. So as an owner of a business, your objective for the year may be what you want your sales to be at the end of the year, or what profits you want at the end of the year. I'm sure at Rotary, again, every year that you'll start with certain objectives, right? So that's your step 1. And we believe that that's the most important step when you start management, because knowing your goalpost is extremely important. And what you want may be very different from what the next person wants. So your step 1 is defining your objective. Step 2 then is deciding a strategy which will help you reach that objective. And clearly there have to be certain principles in place when you come up with your strategy. But that is your step 2. Step 3 is where we see a lot of cracks develop. You may have the right objectives, the right strategy, but when it comes to implementation, people start implementing it in bits and pieces, right? So implementation of your strategy is very, very important. And step 4 is constantly monitoring the direction. Is the strategy that you have come up with really working in order to achieve your objective? Are there any changes in the environment, changes in your objectives itself? So having an MIS and monitoring your direction is very, very important. And our belief is that if these are the 4 steps of management, it should be no different when it comes to managing your wealth. Right? So let me for today just focus on the first part, which is the objective part. Now, I think when one has wealth, you are going to possibly use your wealth in 2 buckets. You can either have a consumption bucket, which is the bucket of wealth that you are going to consume during your lifetime, either for yourself, for your children, for travel, any of that, right? So that is your consumption bucket. But invariably, or many times, we see that there is a second bucket, which is what we call your surplus wealth or generational wealth. Now, since I don't know what each of your consumption objectives could be, what we have really put down here are what are some of those objectives that people have for their surplus wealth, or what are some of the objectives that high net worth individuals should have when they are managing their wealth, right? So the first, of course, is from a return perspective. This is the first question that everybody asks us. What is the rate of return you can give me? And I always turn the question on them and tell them, what is the rate of return you think you should be earning, right? And the way we, again, look at the rate of return is that it doesn't need to be the highest rate of return or the best rate of return, but it needs to be a sensible and sustainable rate of return that you're able to earn over a long term. And what is really put up on the slide is that we believe a sensible rate of return is a rate of return that beats. I've written a word here called HNWI, and I'll expand that for you. That is high net worth inflation, right? If you can earn a rate of return that surpasses HNI inflation by 3 to 4%, it would be a sensible rate of return objective, because not just will you be preserving your purchasing power of wealth, but you'll also be enhancing your purchasing power of your wealth. Now, why do we make this distinction between inflation and HNI inflation? What is the difference? The way we look at it is that the government gives you a number of inflation. That's your CPI inflation. But if you really if you break it down as to what makes up CPI inflation, more than 50% is food and fuel. But I think if you look at the expenses that you and I have, I don't think many of us spend 50% on food and fuel, right? So what we really did to make this more relevant for our clients is that we looked at what are the kind of expenses our clients have, whether it is eating out at a restaurant, traveling abroad, educating children. And there were a list of almost 8 or 9 expenses that we took into account. And our sense was that while your government CPI inflation talks about around 6 to 7%, that HNI inflation is actually in the range of 9 to 10%, right? So very clearly, what am I saying? That your first objective, which is a return objective, should be to maybe earn 3 to 4% above HNI inflation. The second objective is not just on returns, right? I think there is this understanding that as wealth advisors, what we do is only advise our clients on returns. How do you grow your wealth? But there are other aspects that also affect your wealth. And we at Anand Rathi try to take care of that. So what do we mean by safety nets? Today, there are many unforeseen circumstances that can occur. We call these acts of God, wherein your assets could come under risk or could get attached. So when we advise clients, we do ask them to look at that aspect as well when they are managing wealth in such a way that can you create liability-free assets today so that if such a risk does come up later, whether it's to do with your business or anything else, that your assets that you and your family need are safeguarded. And I will expand on this point a little later in the presentation. The third objective, very simply, is that all of us need an estate plan, which is that today this is wealth that we are managing, but apart from what we consume, we need to pass on our wealth after our time. And while I understand it's a very, very sensitive topic, it's very important as well. So we help our clients create an estate plan in such a way that you are able to ensure zero transmission loss when your wealth moves from your to the next generation, right? These are just 3 simple objectives that we've put down. There are a lot more objectives that we do help our clients with. But for today, I will just stick with these 3. So let me go forward. This, I think, as Vijay knows, is my favorite slide. It's just to go a little forward on that topic of inflation that I was talking about. And I'll just let you take these numbers in. Right. My key takeaway from this slide has always been, 3 things. One is that if you have 10 crores today, what 10 crores can buy you today, even if I go by government inflation numbers, is going to cost you 76 crores maybe in 30 years. If you go by HNI inflation, what you can buy with 10 crores is going to cost you 174 crores. But let me not sound alarmist. Right? The way I like to spin this around is that if I do grow my wealth by 7% today, I may have 76 crores 30 years down the line, and it may look very good. But if I'm willing to grow it by that 3% more, right, that number is almost a difference of 100 crores. Now, when I tell my clients, pull your money out of a fixed deposit and let us invest it at a 10%, many times the response I get is, for this extra 2-3%, why are you asking me to take a risk? I think if the difference that one realizes that in 30 years, that difference can be as high as 100 crores on a 10 crore base, then one would understand why even a 2-3% makes a difference. And that brings me to the point that compounding is genuinely a great aspect to look at, and it's probably why it's called the 8th wonder of the world, right? So please do make sure that your money is not growing at 6-7%. It can make a lot of value difference to your wealth for you and for your family. So I've focused right now on the objectives, but like I clearly told you, when we create a strategy, right, when we tell clients, please earn 10% or 12% or 14% on a strategy, the first thought that many of you may have is that, okay, this is going to involve me, taking a lot of risk. So let me spend some time on what the key principles that we follow while creating strategies for our clients are. I've just put 2 principles down here. The main principle that we follow when we advise our clients is to have the right asset allocation. And what do I mean by that? Today, you may have your entire balance sheet, but how you distribute your wealth today is what is actually going to determine your long-term returns. And this is not just something that we believe in. We actually saw that most of the pension funds in the US follow this principle. And if you do a back testing, it really says that 93% of your decision of where you put your wealth, in which asset class, really determines your long-term returns. Having said that, we spend very, very little time on that, right? What do we spend time on, right? We spend time on the second and the third part, security selection and market timing. Should I buy? Security selection is basically, should I buy this stock or should I buy the next stock, right? But if you look at it, that actually has, in the longer term period, just about a 5% impact on your overall returns. How much you put into equity would have actually determined your long-term returns, right? And we also spend a lot of time on market timing. Should I get in now? Should I get in after the Russia-Ukraine crisis is over? Should I get in after elections are over? Should I wait for another 10% fall in the market? A lot of those are, it makes us feel very good when we think we are getting in, at the bottom of the market. But if you have actually seen over the last 10 years, whether you entered the market pre-election, post-election, would have made a difference of maybe 10-15%, if at all, to your portfolio for that period of time. Over a longer term period, it really didn't matter. And just to expand on this, I've put certain numbers here just to reiterate what I'm saying. The example 1 basically says that, let me assume that I have a 1 crore portfolio. I have 50% in debt, 40% in real estate, 10% in gold, nothing in equity. If I had done this from 1990 till date, the average return I would have made is around 9.34% compounded. My 1 crore would have grown to 16 crores. The second example tells me, even if I had had 10% in these two mutual funds, right? The difference would have been that my compounded returns moved from 9.3% to almost 14%. My 1 crore would have grown to around 56 crores, right? Just 10%. And I have again shown another example of maybe another two funds, because I don't want it to seem like I'm marketing these two funds. I just took two funds that were there since 1990, right? There were only around 10 funds that were there in the market at that point of time. So I've taken two funds here and two funds here. You may have made a bit more here, and you may have made, an annualized return of closer to 15%. Now, let me go one step further and assume that in that same asset allocation, instead of 10%, if I'd had 30% in equity, you can see the difference in numbers, right? Now, back in 1990, if I had told you by putting 30% in equity that you're 1 crore, without compromising on your real estate and your debt investments, your 1 crore could have been closer to 186 crores today. You'd have told me I was being a fool, right? Why am I able to say it with confidence today? Because these are all data points that are there in the market. If you go to any of these funds and check how they have done, these are all data points in the market. Now, my point that I'm trying to make here is not to put money in equity. My point here very simply is saying that in the longer term, your asset allocation makes a difference. This doesn't mean to say that, hey, you have to put 100% into equity or put 80% into equity. It basically says have real estate, have debt, have gold, have equity, but in sensible allocations in such a way that it makes a difference to your overall balance sheet. Right? So I think I've spoken enough about this point. This is again just a data point to tell you where 1 crore would have been if you had invested into any of these asset classes. Not to say that there wouldn't be exceptions to the rule. Many times when I show this, I do have clients telling me, but hey, listen, I had a piece of real estate in 1990, which has done a lot better than 10% per annum. Absolutely. We've just taken averages, right? Similarly, there will be certain stocks that maybe did a lot more than 22% per annum. But the point that we're trying to make here is that you can just do professional management through equity mutual funds. And if you can make an alpha over the markets, these are the kind of wealth values that you can make over a period of time. Right? The point that I'm going to close here is that asset allocation is the key principle that we follow and is sensible to follow when creating your strategy, whether you do it with us or whether you do it by yourself. The second principle that we follow at Anniversaries is that you should never look at one side of an equation. Right? We're talking about returns of 12%, 18%, 20%. But there is another side to wealth management or money management, and that is risk. Right? If you see, there are very simple terms put here: expected return and risk management. The reason we say expected return is that return can only be something that we can expect, having certain principles in place, looking at the environment, making certain assumptions. But risks are something that we're aware of, and therefore risks have to be managed. And until you look at both sides of the equation, that is not holistic wealth management. So when people come and say, but I can make 20% and 25%, I say, great. But can you please tell me with what level of risks? And our understanding of risk is that you cannot speak about risk in English terms when you're speaking about risk in number terms. If I'm going to say 20% return, I have to be able to give you a number in risk. Because when I say something is a low risk or a medium risk option, what is low risk to me may be very high risk to you. So both sides need to be quantified. And in our strategy, we do this through statistical parameters like standard deviation. And I won't get into that today because otherwise it will become a very, very technical discussion. It is basically to say that when you do wealth management and you are looking at returns, when you are making a choice of a product, please also look at the equivalent risk and see if you're comfortable with it. So far, I have spent a lot of time on the first objective that I told you, which was the return objective. So I will now spend some time on the second objective, which was the point of, are you doing enough to safeguard your wealth, right? So what are some of these unforeseen risks that one should take into account when you are managing your wealth? One could be a business risk. If you have your own business, if you are the sole proprietor, and therefore, if there are, any kind of troubles in the business, can my personal wealth get attached? And I think, in a place like India, it is not that the fault may be yours, but if assets get attached, it takes a significant amount of time for that to then get to come out of that situation, right? So if you have a business risk, it could also just be something wherein you have, maybe a farm or a shed where you keep things for your business. If there is a fire, right? Those are also risks. If there's a loss of lives, we've seen that with a lot of clients, right? The businesses are run absolutely fine, but these are risks beyond their control, right? So if you have a business, should you be looking at least safeguarding a portion of your wealth? The second is, if you have a professional risk, basis the designations that you have, you are signing a whole lot of documents. Could there be a risk tomorrow? And the third is, of course, in certain cases, if there is a possibility of a family dispute. We have seen that when wealth values grow large, not to say that family disputes happen because people don't get along, but invariably there can be confusions. And therefore, in those cases, should I look at, or are there vehicles available today for me to safeguard my wealth? And the answer is yes. And I will tell you what those vehicles are. Very simply, they're called private trusts, but I will elaborate on that, depending on one's interest, if it's applicable to you. Right. And the third objective, like I said, is estate planning. This is applicable to everyone. It's applicable to you. It's applicable to me. And I think COVID, unfortunately, made it a little bit more real for us that we need to plan for the wealth that we have today as to how we want to move this on post our time. Many of you all may have actually planned your wealth very well and grown it in terms of return and risk. But this is something that, I would request you all to look at. How do you do it in such a way that there is efficient and smooth transition of wealth to the next generation? Family disputes can be avoided. And also, I think going forward, there's a lot of talk as to whether estate duties could be reintroduced in India. It comes up every time towards the budget. So far, we haven't seen it, but I think given that, we are, in the top 5 largest economies today, and other than China, that the others do have estate taxes, it is anybody's guess whether it is going to come up during our lifetime. And therefore, planning for it today in such a way that maybe our families can at least not avoid, but reduce the amount of estate taxes that they may have to, deal with, is something that we should look at today. So how does one really look at estate planning? It's very simple. There are 2 ways you can do this. One is definitely to have a will. And this is a document that will come into play after one's lifetime. The second is, like I said, to have a private family trust. A private family trust enables you to choose today how your estate should be passed on, who the beneficiaries will be, and allows you to have a little bit more control during your lifetime. And again, having a private trust is something that people are looking at in order to avoid or reduce the amount of estate duties that can come up if it so comes up, right? So having said that, I think I've covered most of the points that I wanted to make today. I didn't want to cover more than this because otherwise it becomes a one-way discussion. And given that I know that, this is a 45-minute slot, I would rather, it be a more interactive session. So I'm going to stop sharing my presentation for now. And, hopefully this was interesting, but yeah, would be happy to take any feedback or any questions that you all have.
Thank you, Aarti. I must tell you that it's one of the most articulate presentations I've seen in recent times. Honestly, absolutely brilliant. So clear, so crystal clear, and you're a wonderful presenter. Really beautiful.
Glad to hear that.
Open for questions, friends. Please go ahead and unmute or raise a hand.
How do we get the wealth first?
I don't know if I can answer how you can get that wealth, but I can only tell you whatever wealth you have today is something I can tell you how to grow.
So what would have been, you said 7, 8%, 10%. Over the last, if you look at the last 10 years or so, what would have been a good return, if you would say? I mean, I know people would have wanted 15%, 20%. Some people have made 20%, 30%. In your view, wearing a different hat, what is a good return at this point of time, if you say? Satisfactory return.
So I think a satisfactory return is, what I said, which is really HNI inflation plus 3 to 4%. And in the last 7, 8 years, if one had an asset allocation which was, not a very high risk asset allocation, you had approximately maybe 40 to 50% in equity, another 20% in debt, and the rest of it in what we call products that are really a plan B or a mid path, which is a more hybrid kind of an asset allocation. The kind of returns people have made on a compounded basis is anywhere between 13.5% to 14.5%. And of course, I'm sure there are lots of you who have made a lot more than that. But again, I will reiterate, this is keeping risk levels fairly sensible in such a way that you can predict over a 3-year period that there is at least a 95% or 97%, I will not lose my capital because that is a risk. And at least an 85% probability and a little higher that I will at least make more than a fixed deposit. So when we speak about risk, and I said we quantify it, the reason we, take 2 parameters is because to everybody, their risk is that I definitely don't want to lose money. And secondly, if I'm going to pull out money from a fixed deposit and give it to you, I have to earn more than that. So when I talk about risk, I always say that earning a 13.5%, 14% strategy is possible with high levels of probability that A, you will not lose capital, and 2, you will at least make, there's an 85% probability you'll make more than a fixed deposit. But very simply to answer your question, I think what a lot of people have made with sensible asset allocations is anywhere between a 13 to 15% compounded.
I have a question, Aarti.
Yes.
Do portfolios go through a cycle? For example, if you look at somebody like some of my friends, let me put my example. I did very little on real estate, more on other things. Many of my age group put more on real estate. So they made big money, especially those started 95s. Now the situation is different. So when you say a portfolio, you're giving us a portfolio, what would be? Does this also go through a change? How often do you allocate a change in portfolio based on this phenomena?
So that's a great question, actually. Yes, portfolios go through cycles. In fact, every asset class goes through cycles. So if you look at it, there are 2 growth asset classes. One is real estate, one is equity. And each one of them go through a cycle of growth and then go through a period where they have, I won't say stagnant growth, but maybe lower growth than the average. Now, real estate traditionally has been an asset class that if you look at it across people who maybe started investing in 95 or even before, real estate would make close to 70, 80% of their overall balance sheet. Now, the reason for this was traditionally real estate and gold were the only 2 investments that people used to make. One was because financial investments, there was very little information about it. The second part was real estate and gold were the only asset classes that could take in cash. That as an importance has really reduced over a time period. And if you look at it, real estate has really lost its sheen. And we continuously have been telling clients that please reduce your investments in real estate because yes, you may have made great returns so far. But going forward, or if you take the last 5, 7 years, I have found very, very few cases other than maybe the odd piece of land that people have really bought into. Very rarely are people making more than 4 to 5%. And there is illiquidity in that asset class. The other reason it is showing a degrowth or a lack of interest is that the next generation, right? A lot of your children are not sitting in India today. A lot of them are sitting in other countries. And when they have to manage this wealth, managing real estate as an asset class is not what they want. So there are a variety of reasons why real estate is seeing lower interest today. Also huge supply, very low demand. But I think to again be precise about your answering your question, asset classes do go through cycles. However, if you can have the right amount of asset allocation to each of those cycles and not really try to time moving out of one asset class and getting into the next asset class, you will make an average return. If you have an advisor who tells you, yes, there's going to be a huge risk for the next 5-10 years, so stay out of an asset class, that definitely makes sense. But would we tell you to go 100-0 between any asset class? No. You have to have the right amount in low risk assets, the right amount in medium risk assets, and you actually don't need high risk assets.
Thank you.
I'm going to take this opportunity to also just explain to you all a little bit about the behavior of equity as an asset class. There is again a thought when we as advisors come to you all that we are going to ask you all to put money into equity. Having said that, one of the things that we take our clients through is that equity or the Nifty, if one goes back since inception and looks at how the Nifty has really worked, we ask clients to invest for a 10-year period, right? But as a client, will you invest into equity for a 10-year period if you've had a bad experience for 3 years? The answer is no. So a lot of people who've stayed out of equity is because they've had a bad experience for 3 years. But the behavior of equity, if you look at it since inception, is that on a 3-year basis, it actually gives you lower than the average return, 65% of the time. It's only the balance period of the time that it has given you more than the average, and significantly more than the average that has taken the average back to that 14-15%. So when you are investing into an asset class, I think one of the key principles or rules that you should have is understand the behavior of that asset class before getting in, and then you will know how long you have to stay invested. So for example, if you are investing into equity, please do not invest with a 1-year timeline. Can you make returns? Yes. There are people who made 90% in a year. Can you lose money? You can also lose 60% in a year. That's the maximum loss people have made. So invest with the right time frame when you are getting into an asset class.
Thank you.
I hope that answered.
Yeah, beautiful. Thank you.
Absolutely. Brilliant. Any other questions? Tell us a little about gold as it stands today, Aarti. I mean, what is the situation on gold?
So instead of telling you what the situation on gold today is, let me explain to you how gold as an asset class works, right? So there are only 2 fundamental reasons why gold will go up. One is the central bank holdings, and the other is consumption. And we have some data on this, and maybe I can actually put that up, or let me just talk about it, right? What we have seen in the last 5 years is that of the top 5 countries, only 1 country has increased its gold reserves in the last 5 years. And 6 of the top 10 countries have actually decreased their gold reserves or are maintaining it at the same level. So in fact, if you take the US or if you take Germany, for example, Germany has decreased its holdings in the central bank by almost 19%. The US is basically keeping it as is. So if we expect gold to go up because countries are going to increase their reserves with central bank, so far the data is not showing that. Which brings you to the second point as to why gold will go up, which is consumption data. And again, what we've seen, if we take the top 5 countries, which is China, India, the US, Germany, Turkey, actually speaking, other than Germany and Turkey, which has approximately a 7% growth in terms of consumption, even a country like India actually has had consumption growth of only around 3.5%. Now, the funny part is people may hear this and say, Aarti, you're wrong. Because if you look at gold prices have gone up by almost 75% in the last 10 years. If you see gold prices in dollar terms, it's grown only around 16%, right? Which on an annualized basis is around 1.5%. So why has gold grown by around 6% in India terms? That is only because of depreciation. So I think, the way we look at it is that if in course of time, yes, the rupee is going to continue depreciating against the dollar. But what we're also noticing is that the depreciation is not as high as it was before. So if the rupee is going to start strengthening against the dollar, Gold as an asset class may not continue its sheen from a depreciation perspective. However, if you are comparing it to what can one make in gold again over a 7-8 year period, I would think that it's in the range of maybe 4 to 8%. And therefore, if it is a comparison to having gold compared to the debt in your portfolio, yes, you can definitely have a 10, 15, 20%. But if the question is why hasn't gold been going up in the last couple of years, it's simply because neither consumption, neither countries in increasing their holdings in the central bank is really encouraging that commodity. Can it change going forward? Maybe. But as of now, we need further data to tell you that it's going to go up significantly. As a hedge, absolutely. Good to always have maybe 10% in your portfolio.
That answers.
So Aarti, I had a question, right? And this is more kind of, on the fundamentals as a wealth manager. In the recent past, we have seen a lot of, not a lot, but many issues where, that there have been integrity issues with, some of the mutual funds. I think recently there has been something around, how a fund manager in one of the, reputed mutual funds put their interests first. So when you are managing, right, HNIs, how do you all kind of proactively sense or look at these as parameters to then decide, right, whether you want to continue or whether you want to exit certain brands and funds?
Great. So for starters, I think we have been a little lucky that, as a wealth management firm, we've not had any of these situations. But let me tell you the selection methodology we have when we choose mutual funds. So, clearly, what a lot of people do when they choose mutual funds is, again, to only look at the return aspect. So you go to a value research or you go to an equity master and you look at what are the funds that have done well in the last 3 years, 5 years, and you choose your funds basis that. Our selection methodology is a little different. While, yes, we do look at past parameters, not just in terms of returns, but we also look at other statistical data points of which funds can maybe predict which funds will do better in the future. We look at certain futuristic parameters when we choose schemes. A lot of that is the first step of how we choose schemes. The second step is that we have an entire team which comprises of my CEO, our deputy CEO, the mutual fund head, our chief economist, who also speak with every single fund house, every single fund manager. And apart from having parameters such as we only look at fund houses that or fund managers that have X amount of experience or schemes that have been around for a certain time, they have an interaction with these fund managers on a monthly basis in order for them to get a sense as to, do we really trust the fund managers we work with? Do they have certain audits in place? Do they have certain data points in place to show us that we can really trust the people that we're working with? And not to say that things can't go wrong. For example, did we have clients who had investments in a Templeton debt fund when the entire crisis happened? Yes. Having said that, we were able to go back to clients almost, I would say, 10 days before the entire event came up and tell them that actually this is not just a risk in Templeton. At that point of time, we felt that there was a risk in the debt funds markets overall. And so therefore, we took decisions to just move out into what we call treasury funds or overnight funds till that problem really went away. But I think to answer your question, how do we as wealth managers really handle this? The only solution is that you need to have a team that interacts with these fund managers and with these fund houses on an ongoing basis. We do have, I think, certain unwritten rules, given that we are actually today one of the largest wealth management players in the market. We do have certain, I think, guidelines that we also have with these fund managers that they have to give us data on a weekly, fortnightly basis. And if we see any kind of red flags, we do take it to our clients. Hopefully, this will not be something that the industry has to see overall. Because I think 2-3 cases having come up in such a short term, I think SEBI also is taking note of that and trying to put certain guidelines in place that will avoid it for the larger investment group as a whole.
Great. Other questions?
Aarti,
Yes.
what is your take on cryptocurrency?
I was waiting for this question to come up. I was surprised it waited till the fourth question. However, I'm going to disappoint you with my answer because I don't actually have much of a view on cryptos, not because we don't want to have a view, but I think as a firm, if you see what we do, we need to be able to understand the fundamentals of any investment that we do. We need to be able to understand the risk of any product that we do. And we've never been able to establish what are the fundamentals for why crypto should do well. Can it do well in the future? Yes. Are there data points today telling us why a particular crypto should do well? What is the risk involved? We haven't seen that. And I think, not to, go out and say that people haven't made money in this. But again, if my objective is that I want to make 13, 14, 15% return, I don't think one needs to look at an asset class that is as new as crypto. Are you missing the entire way up? I don't think so. I think the government, as and when they are able to regulate it, and for us, that's very, very important. If an asset class is not regulated, we are not comfortable with it. It is not that we've not made these mistakes before. We have stuck our neck out and done investments that haven't been regulated, that had the lure of earning 20, 25%. And when a client burns his hands, right, it may be 1% of 100 rupees, but he will not come back to you. So we as wealth managers are very, very clear. Till we get adequate data to tell us that cryptos is the way to go. These are the fundamentals why it should go up. These are the risks, and you can measure your risks. We're not looking at it, and I think there's a reason why the government changed taxation also on cryptos. And very clearly, if you're going to get into it, you're going to be paying huge taxes on it. And if you make losses, you can't set it off against the gains that you make. And God forbid if somebody was invested in crypto like Luna, we heard that it's come down 99%. So we are very, very conservative wealth managers, maybe boring wealth managers, but we really don't get into cryptos. We would rather people first start investing in asset classes that are there, that we understand, rather than jumping right into cryptos.
Okay, thanks.
Does Anand Rathi handle only large portfolios, or is there a minimum size of portfolio that you manage?
No. So no, we don't handle only large portfolios. And I think there are two reasons for that. Safe to say, even though I've been in this line for 20 years, most clients love what you say, but they're only going to entrust you with your wealth when you can really prove to them that you can make them money, right? And therefore, we've realized that you may be, sitting on 100 crores or 10 crores or 1 crore, but you are only going to give us a certain portion of that, see that it works, and then grow your portfolio. And therefore, we, in order to be able to at least exercise what our strategy has, which is X amount in debt, equity, and what we call market-linked debentures, which is the plan B, we start with at least a minimum requirement of 50 lakhs, not because 50 lakhs is what we want to start with, but if we start with anything lower, we may not be able to really execute your strategy in the way that we really want to. So 50 lakhs is where we start, and then we have different advisors who handle different levels of portfolios over a period of time.
Got it.
But just one point there, we may take 50 lakhs of your portfolio, but when we advise you, we will advise you on your overall balance sheet, because we need to know where that 50 lakhs really fits in. And we don't want to advise you without knowing where the rest of your money is.
Any other questions?
I can see that the time is 8:30, and I know that you all are very strict about timing.
Give us a last market tip, Aarti, before we close.
I think my last market tip is very, very simple. It is, you don't need large amounts of money to start investing. You can start with something as small as a systematic investment plan, or you can start by investing monies, in a larger fashion. But the key point is start investing. That is my first takeaway, or what I would like to leave you all with. The second takeaway is that do not get flustered or upset with volatility or by market news. Because if you are a short-term player, then market news matters. If you are a 1 to 3 year kind of a player in the market, then there are different data points that matter, like corporate results, etc. If you are a long-term player, very, very different factors matter. So please manage your wealth. I think that is my key request to you all. Please manage your wealth. Please have an estate plan. And of course, if you would like us to help you, we would be more than happy. So yes, I will give you Vijay and my details. And on any aspect of wealth management, if we can help you, we will be more than happy to.
Lovely, Aarti. Once again, at the risk of sounding repetitive, one of the most beautiful and most uncomplicated in near-term presentation. Thank you very much. Wonderful.
Thank you. Thank you so much for having us here today.
May I request Rotarian Narayan Nurani to propose a formal vote of thanks?
Thanks, President Vinod. Aarti, really thanks for the wonderful insights on what I would term as proactive money management. And this really kind of, led me to think on the Warren Buffett's 2 golden rules, right? So one is rule number 1, never lose money. And rule number 2, never forget rule number 1. And, have been in the stockbroking, industry in my formative years. So definitely, Anand Rathi is a very time-tested name, right? I think it's there since 1994. So comes with a lot of pedigree and building that reputation in an Indian market is not very easy. So, thanks for the insights you're given. And really thank Venkat, for bringing you in today as a guest speaker. And also, I think we had a lot of good questions coming in from all the Rotarians. I think Anne's are a bit quiet today, but I'm sure they've taken a lot of notes on the background. So yeah, thanks so much. And I'll hand over to President Vinod for the
Thank you, Narayan.
ceremony.
Thank you. Once again, Aarti, thank you so much. And Vijay, thank you for being here. We all enjoyed it. Thank you and look forward to seeing you sometime in person.
Absolutely. Thank you so much and have a good evening.
Good evening. And with this, I adjourn the meeting. Thank you.
Thanks, Aarti and Vijay. It was a wonderful presentation.
Thank you so much, Venkat.